Hi, good evening, everybody. Hello and welcome to the Hsbc India Investment Summit in association with CNBC-TV18.com here in the national capital, Delhi. So the world today is wealthier than ever before, right? Net worth has tripled over the last 2 decades, and in the Asia Pacific alone, wealth has grown fourfold, accounting for 42% or $218 trillion of the total global wealth. We are here this evening to deliberate the extraordinary journey of India's wealth management and investing landscape. Now, the world has transformed in many ways, and the wealth and investment sector is, of course, not exempt from these changes. So from 2000 to 2022, we have gone from just 9 billionaires to 119 billionaires. I'm sure I don't need to tell you this, you'd know it better. But, India is now poised to dominate the global growth wave of ultra-high net worth individuals as more millionaires and billionaires are set to emerge. So keeping an eye on this rapid rise in the number of investors in India and across the world, the summit today will aim to map the growth trends, the enablers, and the future of this constantly evolving industry. So joining us today are some of the stalwarts from the wealth and investment industry who will be deliberating and sharing some important and insightful discussions on alternative investments, international and domestic markets, and of course the trends that are impacting the wealth management ecosystem at large. So let's begin with our keynote address this evening, which will provide a window into the state of the Indian economy and the growth story. To do this, we'll be joined by Ms. Pranjal Bhandari, who's the Chief India Economist at HSBC Securities and Capital Markets. And, just to tell you a little bit about Pranjal, those who may not know, she's a Harvard graduate and was recently amongst the top Indian economists for Asset Magazine's Best Local Currency Bond Individual Awards for 2022. In her address today, she will throw light on some of the most pressing challenges of the state of the Indian economy and how India is poised to tackle the current global storm of high commodity prices, rising inflation, and slowing growth. She'll also highlight the prospects and opportunities that lie ahead on the other side of this tidal wave. So please join me in extending a warm welcome to Pranjal Bhandari.
Hi and good evening, everybody. I'm thrilled to be here to talk about India's state of the economy. The world is in a period of turmoil. Even before it's gotten out of the pandemic, it's in the midst of a series of geopolitical challenges, soaring commodity prices, rising inflation, and slowing growth. Every country, every sector, and actually every individual has been impacted by what's happening over the last couple of years. Today, I wanted to throw out some pressing questions on the state of India's economy and take a stab at answering them. So here's my first question. Is growth in India slowing or is it soaring? Because there is evidence of both right now. And I would answer that currently growth is pretty strong. In fact, we get a lot of data for India, and we find that about 60% of the indicators we track are actually continuing to rise, so growth is pretty strong. And some of the good sectors right now are the services sector and also the agriculture sector. We generally find that the domestic drivers of growth are doing much better than some of the foreign drivers of growth, for example, exports, at least at this point. And we also think that growth is going to be strong through the first half of the fiscal year, FY23. But this is a tidal wave, and India can't go unharmed, and we do think that in the second half of the year, GDP growth will begin to soften. But first, what's keeping growth strong right now? Couple of things. The number one thing is this big pent-up services demand. You and I were all locked up for the last couple of years in our homes. Earlier this year, we got through the Omicron wave, we got doubly vaccinated, and we went out, took our holidays, our children went back to school, we went back to our workplaces, started going back to restaurants, cinemas, and basically created a lot of pent-up services demand. The good thing about services demand is it's mostly domestically created. So when you go to a restaurant, the chef gets his job back, the vegetable vendor gets his job back. Basically, there's a trickle down and the growth impact is very strong. By the way, growth which is led by goods demand is not as strong because the goods could be imported goods. And then the benefit goes to the producing country, which is necessarily not in India. So there's something strong about pent-up services-led growth, and that's what has happened right now. The second good thing is urban jobs are back. We had an exodus of people leaving India, urban India, going to rural during the pandemic. Many of them have come back because their jobs have restarted. And when one person moves from rural India to urban India, his income on average increases by 2.5 times. That is more growth, that is more spending, that's more demand. So that's also been a big driver of growth. And finally, the health of India's banks. India's bank's balance sheet had been challenged for the last decade, but through the pandemic, with such high liquidity in the system, a lot of the capitalization ratios improved. Many of the banks had provisioned carefully, and today they are in a good shape to actually increase credit. So this strong combination of pent-up services demand, urban jobs, and the health of banks is keeping growth very strong right now. But my worry is that after around Diwali, which is the second half of the fiscal year, growth could begin to slow. Couple of reasons. Number one, pent-up services demand by definition ends. You may have taken 2 holidays this summer instead of 1 because you were deprived of a holiday for the last 3 years, but you can't take 3 holidays, 4 holidays, 5 holidays, particularly when, it's so expensive these days, right? Inflation is very high. So at some point, you stop taking those holidays and pent-up services demand comes to an end. So that's one of the reasons. The second reason is informality. The formal sector, the listed sector, organized jobs rose and did very well through the pandemic, but the small firms, the informal workers didn't do as much. By the way, they are a large part of our economy, about 60 to 80% of our workforce. And if they don't do well year after year for 3 years, then at some point, India's GDP growth will get impacted. So their sort of lack of good fortune is a second driver of why we think growth could slow in the second half of the year. And then there's exports. Exports has been a strong contributor to India's GDP growth last couple of years. You won't believe me if I tell you that the GDP growth we had last year, half of that growth came from exports. It was a phenomenal year for exporters. But now, with global growth slowing, a lot of these export prospects could soften a little bit, and we have to be prepared for that. And on the back of all that, we think the second half GDP growth could be a bit slower. I'll throw some numbers. For the full year, we think GDP growth will be about 6.8%. First half of the year, very good, 9%. Second half of the year, not so good, 5%. And that is my general take on the state of the economy. Second question, is the inflation scare over? Now, this is an important question because this is a scare which is global in nature. Again, every country is going through it. And in India, inflation has been higher than 6% for 5 months in a row, and 6% is an important number because it's the central bank's upper tolerance limit. It's been higher than the upper tolerance limit for the last 5 months. The good news is that in the last 4 to 6 weeks, global commodity prices have fallen by about 20 to 40%. That's a great development because at the end of the day, when input costs fall, then your inflation generally falls. So you've had all kinds of commodities from oil prices to wheat prices to edible oil prices to steel and metal prices falling over the last six weeks. And on the back of that, we've also actually already started seeing CPI inflation, WPI inflation begin to fall. Even rains have picked up. Reservoir levels are good. So some of the things are looking much better than they were a couple of months ago. But I would warn you that the scare is not over. And a couple of reasons for that too. My number one reason is that core inflation remains high at worrying levels. Core inflation is important to understand. It's basically inflation minus food minus fuel, the rest of the stuff, which is a lot of stuff. It's all the goods you consume, it's all the services you consume. that still remains high. It's been high for a long time. It's actually hard to bring it down. What we find in India is stickiness in core. When input costs rise, firms are very quick in raising prices to all of you, to consumers. But when prices begin to fall, like oil prices or other input prices fall, these same producers don't cut as quickly. There is what we call downward stickiness in inflation in India. And my sense is that inflation went up very quickly, but coming down will be a slow process. Overall, there is good news. We do think inflation will fall from about 7% now to 6% by December this year. And then next year, it could average even lower, about 5.5%. The not so good news is that 5.5% is still pretty high. RBI's target is 4%, so it's still very high. And also the big problem is that it's mostly led by food prices falling, not core inflation falling. And whenever you depend on food prices for disinflation, you are basically living on a prayer, right? You're hoping season after season that rains are good that year. So, all of that will keep inflation a little volatile. So largely speaking, some of the worst of inflation seems to be behind us. But, I will still be very careful because a lot of volatility could persist. My next question. Should we be worried about the rupee? Now look, there are problems on that front, right? We have a trade deficit which is rising. Oil prices are high, imports are rising, global growth is slowing, exports are weakening. So, the trade deficit is widening. We have a problem there. Then we have another problem. Capital inflows are slowing. A lot of you must have noticed that we've had outflows from equity markets of about $30 billion this year. That's actually not the number I'm worried about, because that number, it goes out quickly, but it also comes back quickly as soon as there's some sense that, valuation levels are attractive. The part I worry about is actually FDI inflows, particularly inflows into startups, because they had really soared in the last couple of years, and already they have slowed by about 40%. This money leaves the country slowly, but it also comes back slowly. And I'm worried about that. So a wider trade deficit, some worry on capital flows will keep our balance of payments in deficit, which puts pressure on the rupee to weaken. And actually we are seeing that every single day. But all is not bad, Let me not sort of paint a really gory picture. All is not bad. Despite all the aggressive selling the central bank has done, it still holds a very solid amount of FX reserves, which is standing as a wall. So, all is not bad. The rupee is still a good currency, middle of the pack, emerging market currency, because the RBI has a lot of FX reserves. In fact, I would say something different. I would say that the RBI should let the rupee weaken. It's important for the rupee to weaken, for our exports to remain competitive. And if our exports are competitive, then we stand a chance of keeping our growth relatively buoyant at a time, when growth is falling everywhere else. So in fact, I would argue on the other side that we should not worry if the rupee depreciates. It's probably a good thing. All emerging market currencies are depreciating. My next question, has the RBI gotten it right? It's not been easy for the RBI. It's worked very hard to strike a balance between, controlling the inflation problem and yet keeping, growth strong. It has raised the repo rate by 90 basis points. It has drained rupee liquidity from the system. All the things a good, responsible central bank should do. But what it does next is very important. And I think there are two things it should do. Number one, let the rupee be competitive. Not be scared about rupee going to 82 or 83. Let it be competitive so our exports remain strong and our growth remains strong. The second thing I would say, raise rates. Repo rate is already at 4.9. Our sense is, it can go up to about 6% by the end of the calendar year, by December. That will be important because if we can actually overcome the inflation problem, then consumers will feel happy, their purchasing power will not fall, and then demand will start coming back. It will actually be good for growth. I know it sounds strange, but sometimes raising rates and bringing down inflation can actually be good for medium-term growth. So, all said, we have a lot of problems, the world has a lot of problems, but we have solutions too. A weaker rupee can help repair the external imbalances, and higher rates can help repair domestic imbalances. So, we have problems, but we have solutions. So, I think we are relatively in a good place. I want to just quickly move on to the medium term because I think that's more interesting. And my next question is there anything exciting out there which we should sort of, feel excited about, even though the current situation doesn't sometimes feel very good? And I would say yes. There are 3 new sectors that are really exciting me. When we were locked into our houses for 3 years in the pandemic, 3 new sectors in India rose. One was high-skill exports. Through the last 5 years, India's share of world trade has risen for high-skill exports like IT services, like export of mobile handsets, for exports of pharmaceuticals and drugs, and also some specialized machinery. All of this is very good because if we have a few high-skill exports doing very well, they can over time influence some of the other sectors which are not doing well. Sectors like textiles, agricultural exports, they can get influenced by sectors which are doing well. So I think that's a very good, a very good development over the last couple of years. Then number 2 is the tech startups. We have an amazing public digital infrastructure, UID, UPI digital payments, India Stack. A lot of new sort of startups have sprouted. They have attracted a lot of finance, VC, PE, FDI, FII funding. In fact, today 50% of India's FDI inflows are to startups, versus about 20% about 5 years ago. And all of these create a lot of impact. They sort of support a pro-entrepreneurial culture, they create jobs, they create capex, they are generally good for growth. Some may argue that this sector is slowing, funding is slowing, and I agree. A lot of people say it's winter time for startups, and I know it's painful. I know a big period of consolidation is happening, but sometimes consolidation is good because once you go through that period, you come out more nimble and you're ready for the next phase of growth. So I know there is pain, but there's also light at the end of the tunnel. And I find this sector generally a very exciting sector to back. The third new development has been all the steps India is taking to counter climate change. The fact that it has signed up to be a net zero emitter by 2070. A lot of changes have happened. In fact, 26% of India's solar capacity was only installed in 1 year, FY22. Today, India has one of the lowest tariffs on renewable energies around the world. There's a lot of futuristic capex coming out of it. For example, green hydrogen. India, over time, aims to be a regional leader in green hydrogen. And I also see this whole energy transition as an opportunity for India. Think about it. 60% of the infrastructure India will have in 2040 has not yet been built. All we have to do today is whatever we will build from here on, we have to build it in a green way. We don't have a lot of refitting costs, which some other countries, for example, South Korea has. We just have to build green from here. And then a couple of decades down the line, everything practically that we produce will have a green stamp. And India will get a shot in its arm in the export market, in manufacturing, and in growth. So I see it as an opportunity. To summarize, this is new economy versus old economy. The new economy, the 3 sectors that I pointed out, are very exciting. They are leading growth. Old economy is weaker, and this is the story of growth right now. Now, my last question, where will growth be once the current storm ends? India's potential growth, India's likely growth at the eve of the pandemic was 6%. If we only bank on this new economy, these startups, high-skill exports, then I think our GDP growth can rise from 6 to 6.5 in the next couple of years. Is that good enough? No, because that will not create the jobs India needs. But there are other opportunities. If we can have a way in which new economy spills over into old economy, old school manufacturing, old school infrastructure, then we can actually raise growth quite a lot. What do I mean by this? Something like digitization of manufacturing processes. We have lots of small firms. If they can get digitized, get better access to raw materials, better access to final markets, better access to credit, all through the digital networks that we have, then there can be huge amount of productivity growth. And I estimate that India's GDP growth can actually rise up to 7.5%. And at those rates, we will be able to solve most of our jobs problem. So I'm going to end now. There is a global storm going on. India will be impacted. Growth will slow in the next couple of months. Inflation will remain volatile. But storms settle, and there is much to look forward to once this storm settles. I'll end with that. Thank you very much for listening to me.
I hope you can all hear me. Yes, thank you very much. That is very, very good, and very good for somebody like me to understand in a language that is so easy. So thanks a lot. We'll now start the first of our conversations. The future development prospects for the wealth management industry look promising, no doubt, and this will greatly aid and accelerate the big numbers that the Indian economy is striving to achieve. So let's move to the first of our chats this evening. Since the shift brought in by the pandemic, there have been an impressive economic rebound, and also new investors are entering the market every day. So the paradigm shift cannot just be attributed to changes in India, but also on a global scale. India is working towards reaching its goal of a $5 trillion economy and the associated effects on wealth generation. The market has seen an extraordinary surge of newer wealth-creating items and assets which have helped to expedite this development further. So let's evaluate this new possibility that has emerged in the wealth management industry and assess how it will develop in the near future. So to talk about this, let me invite my panelists this evening, Ravi Menon, CEO of Hsbc Global Asset Management India, Swaroop Mohanty, Chief Executive Officer of Rbi Asset Investment Managers India, and Anuj Mathur, MD and CEO of Canara Hsbc Life Insurance. So thank you very much, gentlemen, for being here today. Ravi, I want to start with you. First is this, the $5 trillion, the goal that if you look at it, it seems huge, right? Where are we in terms of, say, the road to achieving it? How far have we gotten?
Well, I think going back in time, not too far, 2019, I think the Prime Minister made this announcement. And I think the tagline was 5 by 25, 5 trillion by 25. And I must say that my first reaction was, this is very similar to what everyone in this room does, right? We all make plans, annual plans, 5-year plans. But perhaps this was the first time that one saw the political leadership making a fairly brave statement and a commitment to achieve it, which I thought was an excellent start. So if you visualize that scenario, I'm guessing the Prime Minister with his Council of Ministers, and as usual, in the workplace, when we ask to give our annual targets, we're always lowballing. And then the head will say, no, that's not viable. I'm going to give you something more challenging. And I think that's the whole idea of leadership, right? To give something which is challenging, but perhaps realistic. I think when we started this journey, we were in the region of about 2.1 trillion or so. And today, as of March 22, we are at about 3.2 trillion. And the reason, perhaps, of the slowdown is well known. COVID came in and not just slowed down things, but actually took away GDP. And therefore, the question now is, when will we get there? And frankly, what's so magical about it as well? If one just uses a simple CAGR calculator, it will take you, depending on what assumption you make of growth, anywhere from 3 to 4 years from now. So instead of 25, you're now talking closer to 27 or maybe 28. And if Pranjal's optimistic assumptions of 7.5% GDP growth is achieved, perhaps even faster. But all of this, I think the critical factor is the continuing need for reforms. It can't be one static piece of work which has happened in the past. And again, I'd like to complement the various different factors, be it let's take taxation, which affects everyone in this room, particularly those who are in manufacturing. The rates are perhaps come down to the lowest in the world, and if there's new manufacturing, it's 15%. tie that into the PLI and the incentives which are being offered, huge step up in terms of outcomes. Go down the chain into taxation again, GST took a great deal of time to settle down. That's undoubtedly has caused some stress. But today at 1.4 on an average, you're seeing steady state achievement over there. You're seeing reforms coming in land, in labor, the codified law. So pretty much each factor of productivity is in place. But the truth is, when you're faced with this perfect storm in this world, how do you react to that? And I think if you just see all the events which have taken place in India since, I would say, the 90s, it's been dramatic. When I started my career, I remember, India was facing its biggest crisis, and I was in commercial banking then, and my client was the Indian Oil Corporation, the only canalizing agency for oil. India's GDP was about $250, $60 billion. Keep in mind, our FX reserves are double or triple the size of our GDP in 1991. And same issues. Price of oil had gone up in those days to $40. Not enough reserves, not enough money to import the oil. And as a foreign bank then, we were financing the trade. You could see the ships in the horizon from the RBI building. But they wouldn't come in until their accounts were credited. Things were that bad, right? Some of these stories are going on in our neighborhood at this point of time. But that's where we were in 91. It seems like a very, very distant past, but it is exactly the story which took place at that point of time. But it's forgotten. And now today we are speaking of 5 trillion. So I think as a nation, as a people, we have that ability to overcome, find ingenious ways of doing so and converting that. But to the bigger picture of 5 trillion and what it does, I think the other part of the story, is there's a very large number of our population who live below the poverty line. At 5 trillion, perhaps a very substantial number of that population is going to come above the line. In the last 10 years, we've seen the massive movement in reduction in poverty. At this particular number, pretty much the entire country comes out of it. Just look at it very dispassionately. That will become the greater consuming community, and then the whole virtuous cycle continues. So I'm fairly confident that it will happen. The question is when, and if it is 25 is out of the question under the current terms, but you're talking about a 27-28 period.
Okay, so which is not too bad also, right? Given that we've had more than 2 years of the pandemic and now, of course, any number of issues. So 2022 is going to be the year which reversed it all, but it looks like it has its own challenges. Swaroop, what do you think this journey, what are the legs this journey is standing on?
So I think Ravi talked about some of the aspects of 5 trillion. But before I start, I'd like to thank HSBC for giving us this podium. And when I walked in, Ravi came and said, "Welcome to HSBC." And when I look at this panel, I'm part of HSBC. So thank you for making me part of HSBC. But yeah, it's a very important question, because if you look at the progress of the country, and I was in my graduation in the 80s, and what changed for all of us was the start of the liberalization process or the reform process. And the good part of the reform process is that it's one way. What started in a certain way, if you look at the last 7-8 years, has been consistent one reform of the other. So at a ground level, whether you're looking at PLI to GST, one after the other, we see something significant coming. When you look at broad India, and you refer to it as the number of billionaires that are being created, I'll go one step ahead. And I have a suit tailor in Bandra, and I was giving my measurement, and I'm a little conscious of my tummy growing. And I was telling him, "Master ji, thoda aaram se." He said, "Nahi, aapka problem nahi, ye pura India ka problem hai." So the Indian Masterjis are quite used to making it. But when you put it from an India perspective, not only is the top end making money, the so-called middle class of India is finally becoming big, and the India balance shape wealth is looking like my tummy a little bit. So we have serious money being created, hence some of the consumption discussions that come about. And post-COVID, and the favorite word now is revenge. There is revenge travel, there is revenge eating, it's revenge before everything is real. people have the money to spend. And then when you look at the broad India balance sheet, which was very service-oriented, now we're taking that turn to become a manufacturing sort of journey. Yes, it comes with the caveat that the labor norms and the land reforms have to be put in place, but the journey is starting. In the next decade, we'll see that unfolding. If that were not happening, India on a 10, 15-year journey based on services would be an issue. And the last and the most foremost thing is the digitization of this country. I mean, for me, everything changed when my wife started buying vegetables online. And you've seen, I was having this debate that India is not digitally penetrated. The fact is, to get a jab for your vaccination, you have to go online and register. So the length and breadth of this country is digitized, and we don't realize that we are a biometrically identified country. I don't see a single country as biometrically identified as we are. So when you put all this in perspective, what it leads to is formalization at a ground level. And for this to now shift can happen very quickly. You don't need a very talented tech guy to make the shift. And that will answer all the questions that are now being questioned from the India balance sheet perspective. When I look at the India balance sheet, the fact that corporate India is paying as much tax as we, individual India, is a question to me. But this formalization will change everything overnight. The fact that if you go to 5 trillion and you double your economy, and people don't realize that it's just Germany who's ahead of us, Japan is still not a 5 trillion economy, right? That's how large this will become. So it answers your unemployment problem, it answers your revenue problem. At the bottom line of it is, we now have a platform on which we can now change. Yes, you can always question why has the change still not come, but we are slowly being pushed to a situation where we don't have a choice but to make these changes, and that's not very far away from here.
Yeah, no, definitely. I mean, for a base this size, I can imagine that, it's a challenge. But so the message is that it's, the big things and a lot of small things which are now in motion, right? So Anuj, where does this leave us in terms of investment opportunities? We heard Pranjal, she also said that, there are these 3 new sectors coming up, and of course everybody's speaking about the various innovations that are happening. What are the kind of investment opportunities that are now being thrown up?
Sure, yeah. See, first of all, I'd like to mention that I'm very optimistic about the India growth story, and I'll come to the investment opportunities also. But I think it is fundamentally important for us to understand as an economy, what kind of economy is this? So we are consumption-led economy, right? There are countries who are kind of not too much kind of self-reliant in terms of consumption, but they export. But as a country, I think we are consumption-led. So that is what is going to drive the growth. Some of the initiatives which the government has taken, be it Atmanirbhar Bharat, or even I think during pandemic, we have seen that the global strategy now is that the manufacturing has to be diversified. So China plus one story, which now people are talking about, multinationals are talking about, I think that will bring a lot of business into India. And by the way, yesterday I was traveling towards Agra and I was doing road journey. And in that 2.5 hours journey, I could see at least 4 industrial townships which were coming up on the highway and huge construction activity. So in fact, this reminded me of China a few years back, that you just go along the highway and you'll see economic development happening. So that is what is happening. I think we have to step out of places like Delhi, Mumbai, and then we can see the real growth happening. The kind of money which is going into infrastructure, and I'm from insurance, so obviously I think long term, my take is not next 6 months, but yeah, what is country going to be in, let's say, 2 to 3 years' time. So I think it is quite possible. And in fact, I'll say it is almost certain that maybe in 3 years, 2 to 3 years' time, this country will be 5 trillion economy. I think we are heading in that direction. COVID was a setback for everyone. That's there. Now, coming to investment opportunities, if I look at the country level, I think the consumption-led kind of industries, I think they are the one who are going to be the beneficiary of that. So consumption, clearly. Infrastructure, because there is huge capacity which is being added. When you see India vis-a-vis other developed economies, there is a vast difference, but we are moving in that direction. So I think that is the other area. And third, as I mentioned, I think the manufacturing sector is going to get a lot of good investments, a lot of FDI also. So while Pranjal talked about FDI slowing down and all that, but the way I see, and I'm talking of not next 6 months, not next 1 year, but maybe 2 to 3 years time, because that's the time which you have to give for any kind of investment to kind of mature. So I think in next 2 to 3 years, we'll find a lot of FDI coming in, manufacturing sector doing well. So this is about the country as a country where we are going to get investment. Now, if the question is also on the personal investment side, or maybe I'll come to that later. Yeah. So again, I think we are going through the golden era, and correction has taken place in the market. And I feel that there is good potential. And if you're thinking from long term, if you're thinking for next 6 months, 12 months, it's anybody's guess. But if I look at next, let's say 2 to 3 years time horizon, I think there are good opportunities. And I think gone are those days where the investment options used to be either equity or debt. I think now we have entire horizon. So you have commodities also which are now available digitally. You don't have to physically go and buy the gold. You can actually invest in gold ETF or wherever. So I think there are so many opportunities which have come up in the last 2 to 3 years that financially we are going to see a complete kind of transformation. In fact, I'll also like to touch upon the financialization of savings which is happening. Earlier people used to invest in real estate or maybe in commodity gold. I think now things have changed. So I think the way people are now investing in even real estate for that matter, infrastructure through InvITs, REITs, all of that. So I think that is bringing a lot of money, domestic money into the economy, which earlier used to be parked in, let's say, lockers or maybe in other physical assets. So I think that will also lead to kind of, I'll say, transformation which is going to happen on the investment front. And obviously life insurance as a vehicle from long-term perspective is there. And clearly there is a tax advantage which is quite there in the insurance. I think insurance is the only place now where you get the tax break, you get the tax advantage. So I think we'll see a lot of kind of pull coming in. Otherwise, insurance was always a push business. But what we are observing, and just to share some statistics, the last 3-4 months, industry has grown by a whopping 50%. I'm talking about the insurance industry. So that's the kind of momentum which has come in. People are looking at guaranteed returns, which probably, and thanks to the rising interest rate environment, I don't know how long it will be, but I think there's a big opportunity to capitalize here. Yeah, thanks.
Okay, touche to that. And I can see also, myself daily almost, how people are becoming now more sophisticated, because there was a time when the only question we'd get was, I have 2,000 rupees, where do I put it? Ya market ka kya lag raha hai? Now people send portfolios and say, can you please evaluate it? So there is definitely a shift happening. But Ravi, in terms of, it's said that never waste a good crisis, right? So now we've had a crisis, whether we liked it or not. What are the lessons that you think investors should be learning from it, which will make them more resilient in the future?
I think I'll flip my response by saying, what is it that we can learn from Indian investors during this crisis? It's just been remarkable, right? FPI outflows of $30 billion, the maximum amount, but month on month, Indian retail investors have been coming in through the SIP, lump sum SIP, and that's what's kept our markets afloat. So there is clearly a message in this. Something has happened during this crisis, which is very different from the past. And perhaps the learnings have been, in the past, if there was a crisis, people just went out immediately and then came back when the markets were high, and then the experience was never great. But the business cycles have been very, very short. And I think that perhaps gave people the confidence. This time it started in October, we are now in July, so perhaps it's been a bit longer. But the numbers seem to indicate there is an underlying confidence on what's really taking place, so stay invested. Not only stay invested, continue investing into the future, and I think that's the best lesson. In some of our meetings, we always speak about in the industry that one of the biggest challenges that the industry faces as manufacturers is this daily NAV. It's great, it's transparent, liquidity, everything is available, but that is also the trigger which provides you, oh, markets are down, let me exit at this point of time. And we've seen what's happened in the month of July. I think month of July 22 has been one of the best months in a long time. But how many people actually jumped in on the 1st of July? Because you can never know it. So I think the learnings clearly is stay invested and the returns will definitely be there. Second, at all times, and this is a motherhood statement, but very important, look at the asset allocation over anything else. It's the most critical factor. Fund selection, choose who you want, but you get your asset allocation right, you're home 94% of the way. And what appears to be complex messages, I think, are now better understood. I don't have the data of what portfolio composition looks like. Maybe you do with your afternoon shows, people calling you up. But to your point, I think there is that level of sophistication which is coming in where everyone's now recognizing the need to diversify internationally, diversify domestically. How does all of this happen? It's fine. We got the industry which has done a great job. Mutual fund sahi hai, continuous reinforcement, the various investor education programs. But that momentum has started, and I think that learning is there, and therefore my response, which was perhaps a bit flippant but real, it's things which we have learned from the industry this time. What I'd like to see leading from here is perhaps an issue which is the size in terms of numbers. We've seen tremendous growth during COVID, perhaps called the Robin Hood investors coming into the equity markets, now back to work, more difficult to be trading at work, coming into the mutual fund industry, hopefully. But the numbers deduped is still about 3 crores, right? You look at credit card numbers, they also ballpark in that 3 crore range. And there's enough rationale that we are a very young society, and perhaps that's something which we haven't commented on, that demographic dividend is going to continue to help us in a long time. And that's one area we'll beat every country in the world going forward, even 10, 15 years. But being young also has the issue of the number of people who are earning an income with savings to invest. But that will change gradually, and as we get education into this marketplace, I see these numbers increasing, and I think that will be the best learning for all of us.
In fact, that was going to be my next question to Swaroop as well, because, you have your finger on the pulse of the retail this thing. So broad-based in terms of, investors, like Ravi said that, they're all going back to work now. Do you think that this enthusiasm which we saw peaking during the pandemic is going to fizzle out? Or, like we said, that, baby boomers are now retiring, millennials and all are out. So do you think they will continue with this momentum?
No, I think Pranjal did refer to this maybe slowing down. I have a very contrary view because, what's happened in COVID is pretty remarkable. And then make no mistake, earlier there used to be this before Christ and after Christ. It is now before COVID and after COVID for all of us in our lives. Because we went through 2-3 years or almost 2.5 years sitting in our houses with a virus ruling the entire world, and we scared for our lives. I mean, it's like a science fiction movie, right? I mean, after COVID, I'm a firm believer of movies. Because when I was in class 8, there was this George Lucas movie showing us that, he was moving his hand and things were moving. Today, touch is life. Yeah? So I do believe that the Terminator will come at some point of time. I'm very firm believer of COVID. But seriously speaking, what COVID did to all of us was to differentiate between our needs and wants. This first time. Earlier, we were confused with our wants and we thought they were needs. And we were 2 years not spending anything in our wants, and still life was okay. So post-COVID, we come across as better people when it comes to our financial statements. So most of us, and I'm pretty sure we Indians are very clear on our money, fact is that we've come out of it much better from a money sense perspective, I believe is what it will keep us going. And it'll go beyond the revenge I was talking about, because suddenly life will then come to a certain standstill and life will carry on as usual. But what it has done in the last 2 years was given us this ability to allocate money in a sane manner, which we were doing in a very emotional manner. So I do believe this is sustained. I don't think it will ebb, more than the fact that when you look at some of the salaries in some of the segments, especially in IT, financial services, manufacturing being back, earning is slowly back, and you will realize that jobs are also back. So it's not going to thin, is my view.
Okay, so that's good, very, very optimistic view. Anuj, you know, these investors who we are seeing today, on the one hand, they have crypto and NFT and whatnot. And then the other hand, there is insurance, bank FD. Do you think that there is some amount of innovation which will be required from, say, this end of the extreme, which is yours, to capture the imagination of these young investors?
Right. So I think the journey has already started, and it started during COVID times when I think if you look at the awareness, that has gone up several times. And I started my career at, it was 91, right? So I've seen 92 also. Then I saw 2000 also. I saw 2008 also. So I think these are the cycles. And what I see now, the new India, is very different from what it used to be, let's say 10 or 12 years back. There is depth in the market. And just to quote the kind of money which mutual funds are attracting, I think earlier the flows were about 3,000 crores a month. I'm talking of about 2.5, 3 years back. Today, what I'm hearing is 12,000 crores a month. That's the kind of inflow which is coming from domestic investors. Net, yeah. So which shows that there is awareness. And also, as I mentioned, the financialization of savings. So instead of investing in real estate, houses, or maybe gold, people have moved money into financial assets. And I think that's a big change. And with the disposable income increasing, I think this is going to provide a fillip in terms of financial assets. So be it mutual funds or be it, let's say, stocks or life insurance for that matter. I think all these avenues, people are now finding some attraction there. At least, and one thing which COVID has taught is the liquidity, which is very important, right? So if you block your money in physical assets, probably it will take time for you to liquidate, or you may not be able to liquidate on time. But this is a change which we are seeing now, where a lot of awareness in people and the need for financial assets, I think, is going up. So I think the journey is already on, and what we are going to witness now is that particularly the youngsters, I think their belief, their kind of conviction in the markets has gone up. So we will see volatility, and it's not going to be easy. But end of the day, I think when people see long term, clearly there is a time, and I think there is an opportunity where we can really make money, provided we have long term view and we don't panic. So that's something which I would like to mention when it comes to investments. And particularly this is what we tell our customers, our investors, that have that long-term horizon. Try to create wealth over a period of time. We believe in kind of goals that, okay, first of all, quantify your goals, that what all requirements you're going to have 5 years down the line, 10 years down the line, and plan for that rather than tactical moves. I think discipline is the most important thing when it comes to investing.
Yeah, actually, and I agree with all of you, because I think this is the only avenue where people can make up for the shortfall between their aspirations and their salaries, or reality, as you can call it. But to wind it up, Ravi, we have one target of $5 trillion. Like you said that, at one time it seemed like India wouldn't put out such a target. But do you think this sets the stage now for future targets? What do you think could be next?
Yeah, I hope so. We should be aspirational. And it clearly no one wakes up in the morning saying, I'm going to work to achieve $5 trillion. But somewhere along the way, in that collective psyche of a nation and the pride that one feels, like this, we've been speaking of fourth, fifth biggest economy at this size. It's a matter of pride. And then a skeptic will say, but hello, we have 1.2 billion people, and let's look at per capita. So there'll always be a flip side. But these numbers, like in the corporate world or in a home budget, really gives you the direction that you need to follow. And hopefully from 5, the next step is 10, and that might seem, outrageous. 10 trillion is like a huge, huge number, doubling. But the truth is, in the last 20 years, we've doubled once in, I think, 2004 to 2008, perhaps the best bull phase which took place in India, and a confluence of the world coming together. It appears, once this current storm is over, the world is going to come together, and there's going to be that alignment coming together. And if we've got our building blocks in place before that, we should definitely be far more aspirational in getting to those numbers. So I'm very envious of all the young people in this audience of what that future will hold.
That's nice. Okay, so Swaroop, you think 10 is next too?
Yeah.
Is 10 trillion the next target after this?
Yeah, I mean, see, it's the power of compounding which takes over. I mean, look at it. What happened in 30, 40 years happened in the last 7, 8 years. And it's going to squeeze. And look at the base that you're creating. It's just a matter of time. And that's something which all of us have to realize and believe in. That when you look at this country going to 5 trillion, what will actually unfold? I mean, look at our Nifty 50 is 1.7 trillion market cap. The S&P top 50 is 20 trillion market cap. And look at the gap. And if not 20, we'll become 5, 7 trillion. And what can unfold from that is something for all of us to believe and internalize. Half the times we don't internalize and hence we miss July. Because you're waiting for July to happen and then to invest, right? Now, there is a lot of wealth which will be created in India. Until now, this wealth was being enjoyed by FIs. And if you look at the figure which Ravi put up, they've been selling and we've been buying. And it's a matter of pride that finally we have started owning our markets. And hence, I pray and I just hope that we continue this trend. So whatever wealth will come out of this will finally be owned by Indians. And that's when we guys go back happy. And I hope that happens before my retirement.
Okay, touche to that as well. And Anit, final to you. You said you look at the very long term. So do you see what, 20 trillion or 50 trillion? What do you see ahead?
See, I'm not an economist, so I'll not like to put a number there. But what I can clearly see is long-term secular growth. My own estimate is anywhere between 7.4 to 7.8 is what we can forecast. And then as I think Swaroop said, it's the power of compounding. So it could be a very big number. And also I would like to mention that amount of time which India took to reach 2 trillion economy and then now 5 trillion. So I think the time taken in the past vis-a-vis time which we'll take in future will be much shorter is what I feel. And see, it's like a car once you set it in motion and once it is in third gear and then fourth gear, so it's much swifter. And the kind of regulatory changes which are happening, and let me just briefly touch upon what the insurance regulator is doing now. I think there's huge push. The push is coming in form of penetration in insurance, but I think the savings part itself is growing by leaps and bounds. And I think I would say that, okay, maybe next 5 years, probably we'll see this growth. And look at China. China growth rate has kind of slowed down. So clearly, I think it's an opportunity for India to take over. And I think, again, I'll not put a number, but I'm very optimistic. Okay, that's great because, you see the kids these days and they're way smarter than what we were. So I can imagine that in the future, everything is going to be happening very, at least much faster than what we've been used to. So gentlemen, thank you very much, but I hope you'll still remain seated. We want to have questions from the audience. If there is anybody who'd like to ask a question. Yes, sir. Just a second. Somebody will bring you a mic.
So, I hear your stuff and there's a lot of, I would say, euphoria in this country, even right now. And we say we'll become a 5 trillion economy and a more, and I live in New York, so I'm visiting here. And I see from outside, inside, that while we have a lot of euphoria, we don't want to ask hard questions, I think nobody talks about the core reforms that still need to take place in this country. We talk about demographic dividend, but we don't talk about the poor educational standards, very little amount of money still going into training people well, and we don't really talk about things that will make this country, like just saying, oh, China grew, and China is a $17 trillion economy, and it didn't happen by accident, actually. So I think while we are very euphoric in this country, unicorns is one example, and other examples, what I find is what is missing is we don't ask enough hard questions. We don't challenge the status quo. And I know as fund managers, your job is to be optimistic because that's when people are going to go and put the money, actually. But why are we not? Like last year, we shrunk the most during the COVID of all the major economies, 7.8% minus. So in last 2 years, we have grown at 1.1% total. So why this tendency? And I understand living in New York, being an Indian, this question is asked to me by a lot of Americans also, that why don't Indians ask these hard questions? And why don't we have that? Because I think that will really help this country to grow.
Yeah, I mean, let's face it, we are a democracy, right? And we are far more resilient than the counterparts in the US. I remember that, when the Twin Towers were falling, I saw a lady on screen coming and telling me that I'm traumatized for life. That doesn't happen in India. The highest earning person in India is not a shrink. We don't need a shrink, we are fairly resilient. The good part of it is probably we'll grow less, where we'll grow secularly, right? If we fell the maximum during COVID, today if you see post-COVID, and I do believe that, the jolt that India needed, if you go and see data before COVID, yes, we'd slowed down. But suddenly COVID is a boon to us. And if you look at data points starting from medical insurance sales to two-wheeler sales, we are back across segment. Even at GST at 160, we might be euphoric, but you step out of this room and you go and spend something, the guy will tell you, "Aise karoge to GST bach jayega." That's where the digitization will change everything. See, as fund managers, our job is not to be euphoric. Our job is to give you 50, 60 good stories. Yeah, in India, the point we are making is at this moment, there are probably 100, 200 good stories. It's not about euphoria at all. Yes, I did mention that if we are talking about manufacturing, the land reform and the labor reform need to happen. But slowly you will reach a position where you will have to do it. Otherwise, how will you catch up with this unemployment which is coming up at the bottom of your balance sheet? How will you start talking about the interest on payments which is suddenly looming in your balance sheet? How will you then address that the poor Indian salaried income taxpayer is paying more than corporate India? It's just a matter of time, right? And that takes over. I mean, for the last 5 years, I've stopped watching 9 p.m. prime time, and it saved me a lot of headache in my life. But having said all that, we are probably at a cusp of a very different regime in India, primarily because of the demography we are talking about. And again, I put a caveat to it, this is a 10-year story, because then the skill of these Indians will be tested. But for the next 8-10 years, India at a fundamental level, along with its challenges, will stand at a very different sort of position versus the rest of the world. When you look at the impact of COVID, yes, we are impacted with the 3 Rs. That is your rates, your resurgence, and Russia. But when you look at what will impact Europe, will probably not impact India, is a reality. Yes, we will not ask questions because we are a democracy, but that's how we are.
Ravi, you want to add?
But they are standing at 9%, 40-year high inflation. What will unfold, probably the thing that will save them, trust me, is because the world trades in dollars. If the world didn't trade in dollars, but we are not like that. Well, I agree with you, but we are different people.
Yeah. So that's what I'm saying, that India has a lot of potential, and Indians are dominating in US.
So let's do one thing.
That's the only thing
let's
I'm
call
saying.
all of us
Asking hard questions.
No, I agree with you.
Please do that.
Let's do one thing. Let's gather again 5 years later and reassess this question on India. Yeah?
No, I tend to agree with some of the things which you mentioned, though not the euphoria part. I think we're being partly realistic in the environment. But it's a fact that as a race, as a country, we are far more peaceful people. We don't like confrontation. We don't, in a room like this, very few people are going to get up and start arguing outrageously. That's who we are. But that doesn't necessarily mean that the push towards exactly the questions which you were raising of primary education, primary health care, basic facilities, which is not available to a large part of people, isn't really taking place. It is taking place. It's taking place perhaps a bit, should have been faster. No one can disagree with it. But let me give you one example. In the last few years, you actually now have state governments advertising as a part of their political campaign the improvement in academic records of schools. I don't think I've ever seen it. Maybe it's still the metro city largely. But it's a transformation which is taking place, and every politician is going to address their community basis on which they can get re-elected. And the people are now saying, I want good schools. And I think that demand is, and the transition is taking place. Second, for a generation till the 80s, etc., which was so, survival was the primary instinct, to my generation, which perhaps caught the 91 wave of reforms and benefited and prospered because of policy changes which took place, to my children who are coming in with a level of comfort and confidence to challenge the status quo. They are the people in the audience going forward who are not going to accept exactly what you're saying. So I think there is a kind of a life cycle which takes place, and there's a tipping moment. And this is the moment which will come in. And I think everything which you speak about primary education and sanitation and water, etc., is true. But hopefully, $5 trillion will give you that investable surplus to make some of those corrections.
But sir, with all due respect to education in the US, the average Indian is educated. The average US is not educated, is a reality. We complete school. They rarely go to school, is a reality. Our education might be a little less, but it's a fact there is no data point which will compare to the number of people who are educated, basic education in India versus the US. US higher education will run on Indians, is a reality now, going forward. The number of Indians, and it's a fact that in Mumbai, excepting my son who decided to study in India for whatever reasons, none of my friends have their kids in India. So probably the US schools will cater more to Indian education than it will to the US. It's a reality in the next 5-10 years.
And then, sorry, just one last one. You mentioned the biggest decline, which is true, minus 7.2, but the biggest clawback back to normalized GDP of 2 years ago was also in India. So we get it right sometimes.
Jen, so I'm sure you can, they're coming back over there, so they will give you enough and more time, don't worry. Thank you very much, gentlemen, for joining in. I know there are more questions, but we're, wanting to get ahead with the second panel, but I'm sure that the three gentlemen will oblige with questions once they're off. Thank you very much, Ravi, Anuj, Swaroop. Thanks very much. Okay, so as we move on now to finding the alpha, because we've already established that investors are here in large numbers and they're here to stay. Now, what do they want? They want alpha. So let's explore the realm of alternative investing more closely with our next group of experts. In recent years, the alternative investment products have emerged as a profitable avenue for an economic boom, particularly in Asia and the rising economies. According to the current assets under management, Indian AIFs are akin to the state of mutual funds in 2009. We can almost see the markets taking on a new outlook on alternative investment techniques. So before we can fully embrace this new trend that AIFs and PMFs have brought about, it's crucial to understand how the market will evolve in tandem with alternative investment strategies and spike in new asset classes. So let me invite my next set of speakers who will be discussing how we might find alpha using alternative investment strategies. Ashish Somaiya, CEO of Vito Capital, Shehzad Madan, Head of Nippon India Alternate Investments, and Anshul Sehgal, Head and Portfolio Manager, Kotak Portfolio Management Services. So thank you very much, gentlemen. Ashish, I want to begin with you. One, of course, is that, what is happening on this front, what is the latest innovation, and what is the kind of, say, product innovation we can hope to see from this AIF PMS space?
Sure. I think it's just part of evolution. Like, for example, if you were to see, say, 20 years back, mutual funds were, very low penetration. And like somebody mentioned in the previous panel, say about a couple of decades back, there were only two choices. Either you invest in bank deposits or the post office or small savings, or you put your money in the stock market, or you own land or something, right? In the last couple of decades, obviously, capital markets have become more and more vibrant, more and more deeper. So that result, and interest rates have structurally kind of declined. A lot of focus on compliance and governance. So putting all of those things together, eventually what has happened is that capital markets have become more vibrant. Now, obviously, the first route or the first access point is mutual funds. But in the last 20 years, mutual funds have become huge. Like we are now nearly 40 lakh crores. So 40 lakh crores and, I think about 3.2 or 3.3 crore unique investors. So what happens is that when a product becomes really retail, widely accepted, then obviously it starts getting more tightly regulated, more commoditized. And the kind of risk-return combinations that a mutual fund can offer probably is not enough anymore to cater to all the requirements. Second is, I think investors have become more sophisticated. There's a lot more wealth management, private banking kind of sophistication, more and more high net worth investors. So obviously when people are creating wealth, what they're looking for is very different from what they will look for when they actually have a lot of wealth, right? So I think just to cut a long story short, the point is that all the risk-return combinations that alternates can make are not possible on a mutual fund platform. So let me elaborate on that. For instance, if you want to lend money to lower credit, right, you should not be doing it in a retail product like mutual funds. If you want to use derivatives and create long, short or absolute return kind of combinations, now obviously derivatives come with some sort of risk. And it comes with a lot of sophistication which everybody cannot understand. So that's another use case. Nowadays you are seeing commercial real estate being packaged into real estate investment trusts. Now that again is long drawn, illiquid, not suitable for, mutual fund can't be holding commercial assets, right? So just saying that as capital markets, interest rates, regulation, one is that, all that evolution, investors, need for different risk-return combinations and different types of products which will meet their requirements for maybe wealth preservation. And the other point being that mutual funds obviously are by and large the most common vehicle. But as they become bigger and bigger and as they become ubiquitous across the country, they need to be more straitjacketed, more commoditized. So obviously all the so-called fancy thing has to happen outside the mutual fund arena. So I think broadly these three things is what is driving the growth of alternate space. And we are just going like any, for example, most of our investment thinking comes from the US. That's the mecca of investing. So that's how it has evolved in the US also. If you see today, for example, it's very, the alternate space is growing a lot more rapidly than what you would call the plain vanilla mutual fund space. It always happens with evolution of markets, evolution of investor preferences, so I think that's what we are witnessing now.
Okay, fair enough. There's a nice little niche window which these products can occupy. Shehzad, my question to you is, it's just starting out, right? AIF, PMS is very nascent still in India. But like the previous panel was talking about, how everything is happening at a faster click now, right? So do you expect that this growth for this alternative investment vehicles may be much faster than what mutual fund industry has seen? And what do you expect? Like, where might it be, say, another 5-10 years down the line?
Okay, so let me put it in the following manner. If you look at the industry, as rightly mentioned by the earlier panel as well as by Ashish, earlier you could only do FDs and, a little bit of mutual funds. And in that, debt kar sakte the, equity kar sakte the. That's about it. But if you look at the alternative industry, basically the pickup since 2012, now firstly look at it in terms of the number of offerings you have. So let's look at it in terms of participants. There are about 900 funds which are there, the 900 managers which are participating in the manager. That's a lot. So there are large guys, large organizations like ourselves and like some of our co-panelists, and there are also, let us call it boutiques. Then if you look at the array of asset classes, so you would have everything from, VC, tech investment, startup investment, credit, infrastructure funds, just about everything you could think of, right? Just about everything you could think of is either coming in or will be increasing over a period of time. So the plethora of asset classes is quite amazing, and that is only set to increase. Let's look at some numbers. When you look at the industry, and this is actually a shocker, take these numbers as indicative because there is a little bit of there's a little issue in the way you calculate it, but without getting into the technicalities, In the first 10 years of growth of the MF industry, it grew about, that's from the privatization and from when data is available, it grew at about 12% per annum. You look at from the data, when the time when PMS data is available, it started earlier, that's about, I think 2009 or 2010, it's about, I think, 13 or 14% per annum. And you look at the AIF industry growth, that's a whooping close to 100% per annum. 100% per annum between 2012 to now is an incredible growth rate. So if you look at that number, it's about, let's take it as indicatively a 3 lakh crores across all asset classes in the AIF space. You take that number, which is a huge number in itself, and bear in mind that you're taking investors with a per ticket size of 1 crore rupees, which is a fairly significant amount, especially in a country with a per capita GDP of what we have. You also add the PMS market to that, which is the discretionary equity PMS market is around 2 lakh crores. So you add 2 lakh crores, you add 5 lakh crores, sorry, that's 5 lakh crores you have. Compare that to what is it for, let us call it the equity mutual funds, broadly, and I'm comparing it, it's not fair, you're not comparing exactly with the debt side. You throw that in, and you're comparing about 5 lakh crores with about 17, 18 lakh crores. So already that's the size AIF and PMS has gained, which is in the vicinity of a little over 20% in such a short period of time. So the growth has been phenomenal. It promises to be even more phenomenal because there are different ways of articulating a view. If I take one more minute and just add to what was mentioned earlier, see what's happening today, if you're seeking alpha, incrementally, because the MFs are getting more regulated and because they're getting that much more larger and you take ticket sizes of 1,000 rupees and so on and so forth, they're getting far more straitjacketed, far more constrained. So the freedom they have, the flexibility which they had earlier, they don't have today. The ability to generate alpha is that much more, let's say, curtailed. We have outstanding fund managers in the mutual fund side, don't get me wrong, they are outstanding guys, they deliver great returns and will continue to do.
They're all looking to head to PMS.
No, they're all great guys, they've got great track records and they don't need my endorsement. But I think the important point is that the ability to generate alpha or the potential, let's use the word potential because there's no guarantee that you'd get there, is far higher in PMS and AIF. So if you're seeking that, incrementally a lot of people will seek to invest. That's in the long only category, and then there are a lot of others, but I'll limit my answer to this for now.
Okay, fair enough. Anshul, what is it that is going to actually boost this demand, right? So I understand that mutual funds are a lot more broad-based, but then they're a lot more straight-jacketed. But are there enough numbers, or is there enough of a universe in India for the alternative investment platform to sort of tap into?
The alternate funds platform essentially is providing innovation to the clients. What you have in the mutual funds is, as everyone mentioned, a straight-jacketed solution which a customer can come in and invest in. If he wants diversification, if he wants asset allocation, then the vehicle to go to is the AIF or the PMS platforms, because that is where you have most of the diversification in products and offerings that the client really is looking to get, but he's not getting through the mutual fund route. And if you look at the international market, what's happening in the global markets is that mutual funds are becoming more and more passive. And innovation is shifting to the hedge fund industry. And that's where you are seeing different kinds of products coming into play, and where investors, wealthy investors, knowledgeable investors can invest in those products. I think the AIF route, the PMS route in India is akin to that, where you will see straight-jacketed, plain vanilla products, and there is a large market for that. Customers who want that will go to the mutual fund industry, and clients who are knowledgeable and who want diversification, whether in their asset class or in the way they invest, they will come to the AIF industry. Some of it, AIF PMS, some of it is also because there is this element, I'll go a little bit into depth, this element of outperformance that a client seeks. And the way to get outperformance is different between a mutual fund and say an alternate product. In an alternate product, for instance, you'll have concentrated bets, which typically you will not see in a mutual fund. You'll see mutual funds being very close to the index in how they are investing. In alternate products, you'll have differentials there. And that is the way to seek outperformance in alternate products versus the mutual funds. And there is a market for it. I don't have a doubt. As Shehzad mentioned, the growth in the AIF and PMS industry has been quite substantial. And this is only scraping the surface. It's only going to get bigger and better from here. So we're only at the start.
Okay, so all the very best for the journey ahead. But Ashish, this is a segment where, I can imagine that there is the possibility of superior return, but it also comes with higher risks. So how do you manage investor expectations at a time where, people are still struggling, a lot of people, and I don't mean only the small ticket investors, many large ticket investors are still struggling to understand some of the complexities of mutual funds. So how do you manage or how do you suppose it should be done?
See, I think, when you talk about a AIF or a PMS, it's only a type of regulatory license, right? Ultimately, the return comes, let's say if we're talking bonds, real estate, equity. Ultimately, the return comes from the asset class and the skill set of the manager who's managing the money or making the investments. A mutual fund, PMS, AIF, each one is just a type of regulatory license which allows you to do certain things and not do certain things. So, first of all, I would refrain from thinking or saying that by nature AIFs are more risky, right? Like for example, if you take a long short product, right? It does make deployments in the stock market, but then it uses a combination of equities and derivatives in order to produce a combination which can try to give you a high single digit return consistently, but at the end protect capital, correct? The only thing is that because you are using derivatives, it involves some amount of sophistication. It involves some amount of understanding on, you don't expect the client to just be told that, okay, listen, don't ask me all the complexities, you will get this. It doesn't work like that, right? So there is complexity there is sophistication, and that combination of equity and derivative is being used to produce a certain outcome. Now, in terms of outcomes, it's probably safer than owning just equity. But in terms of how it is manufactured, it's a lot more complex, right? So all AIFs are not necessarily high risk. It's just that there is more complexity and sophistication. I'll give you another example. Now, when you say portfolio management services, the kind of regulatory changes that are happening in mutual funds, I'll give you a simple example. By and large, for investing in fixed income, mutual fund was the chosen option, no-brainer. But I can tell you 3 developments of the last 3 to 4 years, which actually make me believe that going forward, people will prefer to own debt in a PMS rather than a mutual fund. I'll give you 3 examples. Debt is generally considered safe. From here on, I can tell you it's better executed on a PMS platform than a mutual fund. I'll give you 3 reasons for this. First is, mutual funds now have a new set of asset liability management requirements, liquidity requirements, which actually forces a fund manager to own a certain portion of the portfolio in highly liquid assets. So let us say I own a bunch of bonds where the yield is 9%, but regulatory prescription tells me that I should put 20% in cash. So what is that going to do? On 9%, 1.8 is straight away gone because 20% is going to be in cash. Now, if you own those very same bonds on a PMS, there's no need for that liquidity management, because if it is Sumaira's PMS account, those 9% bonds are held in a demat account for Sumaira. And if you tell me to process a redemption, I'm going to sell those bonds and pay you. I don't need to keep 20% liquidity thinking who the hell is going to redeem, right? That's just a simple example. Second, the tax arbitrage between mutual funds and holding bonds is dwindling by the day, right? Third, in an open-ended mutual fund, today in a debt fund, you see a particular yield. Let's say the yield shows 8%. Wow, 8% is a great yield. The fund gets another 2,000 crores. That yield won't remain 8%. So what I'm trying to say is that it's not necessary that all mutual funds are very safe. and all PMSs and AIFs are very risky. No, they all are just regulatory licenses which permit you to do different things for different customer segments. It's just that when people's tastes and requirements evolve, when private banking and wealth management becomes more sophisticated, capital markets bring up more opportunities, like I was telling you about holding commercial real estate in a real estate investment trust. Didn't happen till 3, 4, 5 years back, but it's happening now. I think the market cap of all REITs is over 60, 70,000 crores now. It's like quite a decent category. So it's just evolution, and I think it's set to increase.
Okay, point taken. But Shehzad, is it limited to just the HNI investor, or do you think there would be a time where it would also start becoming, or it would need to become more broad-based?
See, at this point in time, it is restricted to, I would say, okay, let's put it this way, that 1 crore rupees in India is a lot of money, and especially when you look at it from a per capita in GDP perspective. At this point in time, honestly, my opinion, this is a personal one, I know the industry may have different opinions, that's probably a fine way of going about it at this point in time. Okay? Over a period of time, maybe you can bring the threshold down, and it probably will once you get the accredited investors, depending upon what each, let us say, what each manager thinks they want to address. But per se, it is at this point in time restricted to HNI, and some of the categories within that, in my opinion, while Ashish rightly said that there are different categories and you can't paint everything in AIF as broad brush, completely fair. But for a lot of other categories, I would personally prefer that they stay with a certain limited audience, because then you can explain it well, you can invest in that, call it direct education with the investors. So for example, we do, as do a lot of other players too, one-on-one calling, have you understood the product before you invest, and so on and so forth. You can do that at a larger ticket size. You want to make sure at this point in time, it's very important that the great growth the industry has had, there should be no mishap. One of the great things of the AIF industry, there's been no major mishap which I am aware of, at least. And as long as we can continue without any mishaps, that would be good, and then maybe you can bring it down to the lower end of the pyramid. I'll just add one more thing here, and that's, well, not exactly aligned to this panel, but or to this audience. But globally, the largest investors in alternate investments are institutions. Right? So it's everything from sovereigns to pensions. They are the largest investors and insurance companies. In India, there is very little of an institutional market. So it's HNI, typically. You need more of institutions to come in. And over a, like US is, it's I think 70-ish% from these sort of institutions, and then there are family offices. It's hardly retailed even in a market like US. There are some efforts, but it's hardly retailed. So the point being, we need more institutional investors. I know that's not the focus of this audience, so we'll leave it at that. But that would be a great way to grow this. Institutional investors, of course, are aggregating the money from a lot of small investors and doing it. And just on the last point in this, if you look at the EPFO did not invest in equity till recently. And they've had an extremely happy journey in the recent past with that. And hopefully over a period of time, you'll see more investment in alternative investments from organizations like the one I mentioned.
Fair enough. Anshul, one last question to you is that, of course, we are seeing a migration of talent from the mutual fund industry towards PMS, etc. But, I mean, clearly the way I understand it is that, it is highly specialized in terms of the products that you need to offer. And therefore, it requires, that much more specialized domain knowledge. Is there enough talent to sort of fill this growing demand?
Talent has to be seen in different contexts. One is the talent. So assuming that you're an equity, long-only equity fund manager, then your talent has to be seen in the context of picking the right stocks, creating a portfolio. But your talent also has to be seen in terms of the experience of cycles. That do you know how cycles impact this industry? That will this industry in a downturn behave similar to, say, a mutual fund, or will it behave differently? And so given that, would you need to maneuver your portfolio accordingly? Now, that only comes with experience. It's very difficult to get it vicariously. And which is why you will always have, while there may be a depth of talent, but there will be some limit to who can manage funds in different asset classes. And to your earlier point on what are the different kinds of products and all that, much of the innovation is also situational. So take the mutual fund industry. Now you had a segment in the mutual fund industry which was the credit funds, which were about 1 lakh crore, right, in depth. And suddenly you had this liquidity event where credit funds saw significant outflows, but they didn't have liquidity. And so that caused mayhem in the markets in general. And the outcome of that was that that industry shrunk from 1 lakh crore down to 30,000 crore. And you had that, but there was always a need for that product. That requirement is now being filled through the AIF route. And you have that, that pool of assets coming to the AIF route where you can do innovation which suits that requirement, suits that customer. And so this was a situational requirement which actually benefited or could be catered through the AIF route. And so much of that will play out as we go on. It will be situational. It will be the deepening of the market, widening of the market requiring different sorts of products, and that will be done through the PMS AIF route. And there are advantages. Take the case of just this credit requirement in AIFs. You don't have capital adequacy requirements. You don't have hindrances to structuring, which you have in the, say, the NBFC route or the bank route. So lots happening, and as I said, there is a lot of innovation which will happen in future.
Okay, so interesting times ahead, gentlemen. Thank you very much for joining in to talk about this. I wouldn't call it new anymore, but evolving platform. So thank you very, very much. Thank you. Okay, and there's a special announcement, by the way, for everybody who's here. You may have heard the saying that if you want to watch a game, it's fun. If you want to play it, it's recreation. If you want to work at it, it's golf. And to realize this, HSBC is set to launch its Pioneer Golfing Championships platform in India, powered by Thrive. So for the first time in the history of the banking ecosystem, HSBC Golf League will be a one-of-its-kind, tech-driven platform featuring the nation's premier golf league, and also witness participation from amateurs and pros, instant game bookings, handicap scores, and junior golf. So the aim of the championship will be to foster and nurture business relationships. And to tell us a little bit more about this, we'll have the person behind it all, Mr. Jaswinder Sodhi, Head of Customers, Digital and Marketing at HSBC India.
Hi, good evening, everybody. As we are unveiling India's transforming investment landscape, I'm really thrilled today to announce the launch of HSBC's first ever golf championship platform in India, powered by Thrive. The HSBC Golf League is a tech-powered platform that will enable golf enthusiasts across the country to play golf with the professionals and compete with them at the tournaments which are powered by HSBC. Connect with fellow corporate peers, track their real-time game scores, and much more. HSBC envisions to build a very large golf community in the country who will get to connect on course, enable business networking, along with the chance of exhibiting their sporting forte. So as a technology-backed platform, it will provide a lot of data points to improve the overall game, analytics, etc., which golfers always aspire to. And as a last part, the platform has got a lot of compelling features, including golf updates, blog posts, how to improve your game, networking features, and last but not the least, the junior golf coaching lessons. So as an overall package, I can assure you, this is going to be the next LinkedIn for business and golfing enthusiasts. Now, without taking much more time, I would like to play an AV for you. Can please play the AV, please? Thank you.
Jaswinder, thank you so much. Looks like fun times ahead. We're going to finally get to our last bit of the evening, and it's very, very interesting. But before that, we have to take a 15-minute break to allow for the stage to be set up. There is a much-awaited performance, so do join us in the ballroom back in 15.